Ja, meine sehr geehrten Damen und Herren, schönen guten Morgen.
Ladies and gentlemen, good morning. First of all, I would like to welcome Mr. Nowotny of the Austrian Central Bank. I would like to welcome Mr. Würmeling and Mr. Thiele, my colleagues, Mr. Faber, Deutsche Börse, Mr. Schick of the Parliament, Mr. Brandes, and many others, Mr. Tallinger from Allianz. Welcome. It's the 20th event of its kind, and I would also like to welcome Edgar Meister. Edgar, you founded this event, this symposium, and we, as your successors, we tried to keep it alive, and I'm very grateful. Thank you very much for founding this event, and the success shows that it's been really great. So some of you might be wondering what has become of the good old Bundesbank Symposium on its 20th anniversary. Are we not talking about credit risk, own funds, on the banking union? Will we only talk about it in the afternoon? Or will we rather talk about greenhouse gases, melting polar ice caps, or dying species? What has happened to the Bundesbank? Or some people said, has the Bundesbank adopted a devil-may-care attitude? But, ladies and gentlemen, on the contrary, ladies and gentlemen, you see that over the past 20 years, the Bundesbank Symposium has always made a point of discussing topics which drive the financial community. Maybe not now, but maybe later. But that's really essential. And now I would like to use the last such symposium during my term of office at the Bundesbank to shed some light on a matter which is quite literally of existential importance, because I will talk about the climate change and the role of the financial community. It will be in the forefront, and Mr. Lüber and his team and supervision have provided great support to me. It's a topic which is becoming increasingly palpable, not least since the Paris Climate Agreement, which was endorsed back in 2015 and has since been ratified by nearly every country in the world. So it was a global commitment to take action to curb climate change. It was the culmination of decades of effort and an achievement which many thought was scarcely possible. So this global agreement was presaged by the sobering and devastating realization that climate change is man-made and can only be mitigated if all of humanity works together. Successful though the agreement may have been, the true significance of the UN Climate Conference in Paris has not yet dawned on everyone, it would appear. So I think that for most people, it is still nothing more than an abstract arrangement to keep global warming below 2 degrees Celsius compared with pre-industrial levels, and to pursue efforts to limit the temperature increase even further. But I think there's one thing we all need to be aware of. If the global community is even halfway committed to hitting the ambitious target of 2 degrees Celsius, there will need to be some far-reaching changes to the economic systems as we know them. And as for the time frame, the later we get started, the deeper our intervention will have to be. And we shouldn't expect the planet to make things any easier for us if we don't act. So quite specifically, this means we'll need to be ambitious, far more ambitious than before, and we'll need to take a systemic view of the matter in hand. It's not a detail, it has got a systemic importance. Every area of the economy will need to adjust. And by correctly pricing the externalities of the climate change and internalizing them, this is what the economists say. And those adjustments mean much more than simply trimming our CO2 emissions. They will transform the entire way in which we do business and affect the path along which the economy and the society are progressing. I said that these are systemic aspects. So specifically in the economy, I see three control loops in the economy which can be used to tackle climate change. So first, it's about the general issue of green energy of the future. And this is an area in which we have already come a long way. And many people focus on green energy. Second, the matter of green transport systems. Here, and at least this is my impression, progress is still very vague here, and we don't know what the future will look like. And then third, the climate change challenge is sustainable and green nutrition. This is a topic where we still do not have many robust projections about how developments could play out with regard to nutrition. So for all these three control loops, there is no doubt that the financial sector is also affected in everyone. Banks and savings banks, in their capacity as providers of credit for the real economy, will not be left unaffected by the impending greening process in the economy. And this brings us to the subject of our symposium here today and to the topic of my opening speech and of the morning. Green finance, Mr. Weidmann mentioned this term. I think you're all more or less familiar with this term. And in essence, it's about the way in which the financial sector responds to climate change. So the question is how we can help mitigate its impact and promote ecological sustainability. For instance, by channeling funding into environmentally friendly technologies and economic sectors, while also capitalizing on their growth. For me, green finance, as it has been already said, is more than anything patient finance, if you will. So a financial world which looks primarily at the long-term repercussions of its actions. So it's very important to think about the long-term repercussions of its actions. So it's nothing less than a paradigm shift. Will we succeed in overcoming short-term thinking? Will we succeed in prioritizing long-term investment over short-term trading opportunities? I don't think that we're not good bankers. I would say that we are prioritizing long-term investment over short-term opportunities. So don't we want to have shareholders that keep their shares for long times instead of high-frequency traders? So today's event aims to raise awareness about all these questions, and this is why I am grateful that you're all here with us. So from the banking supervision's point of view, there is at least one other aspect which is of paramount importance, and especially so from the perspective of banking supervision, that is risk, which climate change and the transformation of the economy might present to the financial sector, and the matter of how far financial institutions will need to adapt to shield themselves from that risk. And last but not least, we as central bankers and supervisors need to face up to the question of the role we are able to and intend to play in transitioning to a green financial system. These three topics, that is, the risks facing the financial industry, the opportunities for the financial industry, and the role of supervisors are the subject of my speech here today. So let's begin by taking the risk perspective first. So mention climate change, and the first thing most people think about is natural catastrophes, storms, heat waves, droughts, floods and hurricanes, and I understand why it is the first thought. You might remember that Atlantic hurricane season of last year, 2017, it was one of the worst on record. One of the worst we have ever experienced. So disasters on that scale mainly inflict widespread human suffering, of course, but they also present economic risks, enormous economic risks. In this case, we talk about physical risks. as they are known, and those risks can affect every one of us, individuals, what I mentioned before, government, budget, insurers, and also financial institutions. These costs are already materializing today on the balance sheets of non-life insurers and reinsurers today, and they add up to more than 135 billion US dollars for the hurricane season. These are the damages of the insurers, but in total the damages amount to 330 billion US dollars. And this is why these insurers usually make the headlines, but also there can be a direct impact on banks, on saving banks, if the assets that they finance, the real estate, production facilities or tradables are affected. So indirectly this might disrupt value creation and delivery chains that have a knock-on effect on customers, and there is nothing to say that weather and climate-related losses of this kind will still be insurable if climate changes to dramatically increase the likelihood of natural disasters and the expected amount of losses and damages. And then the question is whether these are still insurable. But I think that we still need to think one step further. Besides the direct impact of climate change, there are yet more risks which we need to bear in mind, because the shift towards a lower emission and greener economy is itself a source of potential risks, which go under the somewhat unwieldy name of transition risks. The background to this is as follows. To make this transition, potentially disruptive technological advances and far-reaching changes in climate policy are called for. And all the economic sectors will be affected, and no economic sector will remain unscathed, and it will affect many assets in your balances and in your banking books. Have you already heard the term stranded assets? Do you know this term? Does it mean anything to you? Well, to hit the 2 degrees Celsius target, we will need to curb the amount of carbon dioxide we emit worldwide. This is what I said before. So at a rough estimate, our CO2 emissions are probably not much more than 1,000 gigatons away from exhausting our budget, if you want to call it a budget. However, the CO2 content of the known fossil fuel reserves still in the ground is far higher, something like 3 times as much. And the consequences are quite logical, because it means that much of these reserves will need to be left untapped in ground. But the problem is that many businesses' valuations, businesses that are linked to the extraction of such fossil fuel reserves, depend to a significant degree on the future anticipated value of such reserves. But if those reserves are out of bound, they are effectively worthless, or at least partly worthless, and then they become stranded assets. And then they are re-evaluated. There will be re-evaluations of these assets, and the loss in the value of these assets puts the company's very survival on the line. As a case in point, the market capitalization of the major U.S. coal businesses and producers has contracted by roughly 60% over the past 5 years, and by around 90% over the past 10 years. So you see the sharp devaluation that is due to the climate change. And this during a period against the backdrop of the U.S. equity market as a whole, racing from one record to the next. And this is just one example, but quite a drastic example. So depending on how quickly and unexpectedly the transition and the resulting repricing process take place, they may well have a huge bearing on the stability of entire sectors of the economy. So it will mainly become an issue whenever businesses and investors are unable to plan for the long term because they need to be in a position to respond to short-term policy impulses. This poses the risk of cliff effects, how they call them, which can trigger disruptions and financial losses that then affect the financial stability and its stability, and we are all affected.
At this point, ladies and gentlemen, I'd like to take a jump and move from theory to practice. To what extent would German banks and saving banks be affected by a shift to a lower emission economy? That may be a question that some of you may be asking yourselves. The credit volumes of German institutions and investments in industries with high CO2 levels appear insignificant at first glance. The 1 million euro credits, and Mr. Löber keeps close track of these loans of more than 1 million euros. These investments of German banks and coal mining companies currently amount to no more than just under 1 billion in total. So that's not a huge amount to be too concerned about. However, loans to coal mining companies can make up 1 to 2% of individual institutions' issued loans of 1 million euros or more. So caution is warranted in these cases after all. Furthermore, we must not forget that the greening process will have a much wider knock-on effect if we include loans to just those firms involved in the extraction of crude oil and natural gas and in the processing of coal and mineral oils. If we consider all of these, it boosts the volume of the loans of 1 million euros or more granted by banks to almost 20 billion euros. So Mr. Löper and the supervisors and the Bundesbank agree that this is a more substantial amount. Individual institutions have issued up to 6% of their loans of 1 million euros or more in these sectors which are quite heavily impacted by climate change. If we were to add the energy suppliers to this list, the figure goes up once again to around 60 institutions which issue more than 10% of their loans of 1 million euros or more to the sectors I have just cited. At some, volumes can even exceed the 20% mark. And you can see what I'm getting at here. This is a chain that could keep going for quite some time considering all the different industries and sectors that I've listed. So, I'm sure you can see that this chain could keep going on, but the big question now is, what can we infer from these figures? What does this actually mean? Even though there's a relatively rough and ready overview of the situation, there is no way that we can rule out significant risks for individual institutions. That said, there are some caveats. First, of course, the data that I have provided are of a very low granularity. This makes many correlations unclear, and many of the borrowers included in the calculation are conglomerates that make only part of their profits in energy-intensive industries. So only part of their success comes from these energy-intensive industries. And second, and this may be even more significant, there is a certain degree of uncertainty with respect to how the greening process will plan out, and thus with respect to which sectors of industry would be affected and in which way. Just take, for instance, the automotive industry, quite relevant for the German industry in total. To what extent individual manufacturers or the national automotive sectors will be affected by the economic transition is very difficult, if not impossible, to predict. What climate policy measures will be introduced? Will there be emission limits, bans on vehicles? Will there be free of charge public transportation? Which technical standards will become the norm in the area of sustainable mobility? How far will car manufacturers succeed in playing a leading role in these new technologies, and so on and so forth? As you can tell, there are so many questions that we are currently finding ourselves in uncharted territory. The situation beyond this is also unclear. If we look at historical time series on probabilities of default and losses given default is, in this case, quite pointless with respect to the risk of climate change. So what I'm trying to say is that established risk models can only help us to a very limited degree because we are currently in a phase of great uncertainty. And the next logical question to be asked at this point is, what can we do? If you take only one thing away from my speech, it should be this. It's not enough to examine the issue of greener finance through the lens of corporate social responsibility. That is absolutely insufficient. Potential climate-related risks need to be taken into account as part of risk management. Banks and savings banks need to know just how much they themselves, their customers, and their customers' business models will be affected by climate-related risks. And they need to be aware of the risks that this entails for their financial exposures at these banks and savings banks. Now, this doesn't mean that we need to reinvent the wheel to do this. Even though the sources of risk that we're dealing with are absolutely new, their effects also fall into the established financial risk categories that we are already familiar with today: credit risk, market risk, and operational risk. So certainly things that you are more than familiar with, and we can use the established framework in order to approach these issues too, but you shouldn't oversimplify things either. It isn't enough to have your risk managers log up the exposures to a few high-emission sectors and find that they are manageable when looked at in isolation. A topic such as this cannot be looked at in isolation, and it is also very difficult to handle. Greening is a very complex process. It goes far beyond things that we know today, and it will have effects that we are only now just beginning to understand. So we're going to gain more insights and experience over the course of time. We don't know exactly how things will play out yet. Historical data and established statistical procedures cannot be used as they normally would in this case for risk assessment. Scenario analysis could serve as a useful tool for raising awareness for this problem, raise awareness as to how we may be affected by different scenarios. Furthermore, I believe we will also need to start a discussion about best practices in the financial system. By competing with each other, we can come up with new risk measurement approaches and evaluate them in terms of their effectiveness and benefits. And we've seen some first good examples of how this can be done. Ladies and gentlemen, climate change is quite rightly seen primarily as a challenge for banks and savings banks too. However, we must not forget that in addition to the transition to a greener economy, this can also be a considerable opportunity. Green finance can be so much more than just an opportunity to present a green image, to greenwash. With this new economic transition, of course, new business opportunities will also open up to banks and savings banks, and I believe Mr. Tellinger will perhaps say a word or two about this from the point of view of insurers after that. Now, with all these transitions and changes happening over the past years, it was also the banking industry, the financial industry, which helped change and shape these developments. And that's what is needed once again today. The opportunities are clear to see if we look at the investment required in order to achieve them. The level of global investment needed in order to achieve the 2 degrees centigrade target set out in the Paris Agreement is estimated to run into the double-digit trillions. The European Commission anticipates that additional annual investments of 180 billion euros will be needed in the European Economic Area in order to achieve the Paris climate targets by 2030, 180 billion euros per year. We're talking about major projects in the field such as energy supply, for example, but also everyday financial services such as residential property financing, which could be affected if sustainability standards play a greater role in this area. It's not just going to affect major projects, it's going to affect all areas, basically. We're also talking about funding technical progress and financing innovation. Think, for example, of energy generation, transmission, and storage. But I'm also referring to other topics such as e-mobility or efficient recycling here. So there's a number of very large projects which require funding, and it's thus also a great opportunity. We're going to see an increase in private investors' interests in making investments in green projects. Between 2006 and 2016, the volume of sustainable investment in Germany, Austria, and Switzerland. Austria, Ewald, I put Austria in there for you. Sorry, referring to the years between 2006 and 2016, went up more than 12-fold, rising from around 20 billion euros to over 240 billion euros. So, I think you can see that there is a wealth of potential here at our fingertips that needs to be exploited. The biggest challenge, as far as I'm concerned, is to guide this transition in a responsible manner and help shape it. What do I mean by that? Credit institutions that want to play a role in financing green investment need to either gain or expand their expertise in these relevant areas at an early stage. Because noble as your intentions may be, you have to make sure that you do not fall victim to typical innovation risks. Wherever technologies and innovative products become a hype, there is a risk of distorted valuations and of sudden price corrections, just as it is also the case with any other technology. Only true experts can keep an eye on possible dangers. So that's the way to keep an eye on dangers and, on the other hand, also catering for customers' future expectations and requirements. So it's really about developing the necessary skills. Both of these things are necessary for financial institutions if they want their business to benefit from the economic transition. Now, I've talked at length about what climate change and the economic transition mean for your work, but what does that mean for regulation and supervision? And to put it in other words, how green do regulation and supervision need to be or become? Before I go any further, let me put your mind at ease. Just like you do not need to completely reinvent the wheel in the field of risk management, nor do we banking supervisors when it comes to prudential requirements and all the risks that we need to take into consideration in terms of exposure. So the new risk sources basically are covered by minimum requirements for risk management and or MA risk already. Nonetheless, I do believe that the authorities are in the situation where they have to sensitize banks at this point about these potential risks, especially now at the beginning of this process where awareness has not been raised sufficiently yet, and the symposium is supposed to be a first contribution to this. Beyond this, I believe that climate-related risks may also start playing a role in supervisory authorities in the future. So those of you who participate in supervisory authority dialogue, you may want to keep that in mind, that we are also going to be interested in finding out what answers you have as to risk exposure. As far as I'm concerned, supervisors and central banks should work as role models and catalysts in this process. So, We want to be ahead of the curve, as we already heard earlier. We want to make our contribution to a better understanding of the mechanisms which lie behind the risks. For this reason, the Network for Greening the Financial System was recently established. It is a network of a group of central banks, especially the Netherlands. Central bank plays a very important role in this, as well as banking supervisors around the world who come together in this network to exchange views on climate risks for the financial sector and regulatory issues and so on. So we central banks have already begun this process. Mr. Würmeling, who's over there, is extremely active in this field. What is most important in this context of a supervision is establishing a consistent taxonomy and definition about what green finance is. We need that in order to establish reliable standards. Only if we have the same definitions can we be certain that we're actually talking about the same thing. And Klaas Knot, whom I'd also like to welcome, will tell you a bit more about this in just a moment, because it is one of the essential points that we need to be able to respond to these global demands and requirements. So, as you can see, we are not coy about playing our part as supervisors in the decarbonization of banks' balance sheets. Yet there are also other demands being placed on banking supervisions and regulators, which I'm keeping a very close eye on because I consider them to be dangerous. We're talking about the implementation of the Paris climate targets, and it was discussed that in order to control funding flows, moving them into more environmentally friendly sectors, recently, there have been some demands that banking regulations should create special regulations, either to penalize activities which are detrimental to the economy, or to rather incentivize investments in green bonds. There's one idea, for example, that they should have lower equity requirements. Green supporting factor is the buzzword in this context. So when you invest in a green bond, you need less equity level, lower equity levels. So we're not in a situation where we think that sustainability in this sense of environmental friendliness will necessarily go hand in hand with reduced risk. It shouldn't all be based on factors like this. The only factor that we should rely on should be risk and exposure. Just because a bond is green doesn't make it less risky. The financial market regulation in general and banking supervision in particular need to focus on their core tasks and remain risk-focused. And that's also the expectation that we place on you, the financial institutions. Improving the regulatory mandate is important in this context. Watering it down could create conflicts of interest and ultimately lead to risk of financial stability. The European Commission, as many of you know, will unveil its action plan on sustainable finance today, and it's important for us that promoting the greening process does not take place through the back door via financial market regulation and banking supervision. So we will take an active role in supervising the implementation. Instead, policymakers can use other traditional instruments, such as, for example, tax incentives to foster development. And I think that this is a better approach, and it has less negative side effects. Ladies and gentlemen, the Paris Agreement is a strong political commitment to climate protection. It is now a matter of ensuring that climate protection goals are integrated into the market economy. If we integrate these targets into the market economy, then we also have to include them in the financial economy and industry. The greening process will only be successful if market mechanisms function in the right direction. Sustainable growth needs to pay off. Behavior that harms the environment and future generations should no longer be worthwhile. Climate change is first and foremost, but not exclusively, a topic for policymakers. Financial institutions also have a duty to address climate change and climate policy issues as part of their risk management operations. It is crucial to plan ahead and engage with the topics of climate change, climate policy, and climate risk early on. This is extremely important because, as I already said, we find ourselves in uncharted territory. But there are also opportunities. In their capacity as providers of credit to the real economy, banks and saving banks can capitalize on the greening process whilst also helping to shape it. Supervisors and regulators need to be aware that they share responsibility and need to set a good example while at the same time heeding the parameters of their mandate. Specifically, it would be wrong to misuse regulation and supervision as a means of promoting economic development. It needs a green supporting factor. And I certainly do not believe in incentivizing investments without taking risk into account. Tax regulation, as far as I'm concerned, is a good approach here to disincentivize brown finances. Ladies and gentlemen, I would like to use my final words at this point, because time is running out. Earlier I said we have to be ahead of the curve. Some people may say we're behind the curve already. It depends on your perspective, I guess. But I think we all agree that time is running out. This is becoming urgent. The longer we wait, the greater the costs will be, and the more dramatic the impact will be. What's so dramatic about climate change is that it's something that is quite far off in the future still. Analysts look maybe 5 or 6 years ahead in their forecasts. By the time that we consider, or they consider, climate change and their impacts, it will be too late already to take action. And I would like to encourage you all to take action. And with these words, I will now draw my last speech at the Bundesbank Symposium to a close. Over the past 4 years, I spoke at several of these events on topics such as what is good regulation. We're looking forward to the answer to that question. Digitalization, and that was also one of the topics we spoke about at an early point in time, and for us it was important to be ahead of the curve again. Then last time I spoke about European deposit insurance. I'm certain, know why we did this, and then at the last dialogue or symposium we spoke about Basel III. So it was an honor to speak here alongside such respected speakers such as Danielle Nui, who many of you didn't know when she was here for the first time, Stefan Ingves from the Basel Committee, Sabine Lautenschläger, Felix Hufeld, and also Klaas Knot. So it's, of course, a bit early to bid a proper farewell at this point. I still have about 7 more weeks in office. And although I did make my decision a long time ago to not extend my term in office, I will be leaving with a heavy heart. I wish my successor in banking supervision all the very best, and for the future Bundesbank Symposia as well. I'll always be here to support if necessary, and I'm sure that we'll meet again at some point in the future. I've been working in the German banking sector for 33 years, if we count in my vocational training as an apprentice, and I will certainly remain loyal to the banking industry in the future and its landscape. At the Bundesbank, I said earlier, you may be wondering whether we're adopting a devil-may-care attitude. Well, certainly not when it comes to the matters. It should never be an attitude that we take when it comes to taking care of the future of our planet. Thank you very much for your attention.